This stock market research just blew me away. I'm and I'm not shrinking violet when it comes to, I mean, look, I got Random Walk Down Wall Street by Burt Malkiel. I One Up on Wall Street by Peter Lynch. I obviously big fan of John Bogle. I follow all these guys. In fact, I met this guy named Robert Hagstrom when I worked at Legg Mason, who had written a book on Buffett. It was a great book because he ran the Legg Mason Growth Trust Fund. And I'm pretty attuned to all this stuff. And obviously Jeremy Siegel and whatnot. When I read this paper from this professor, I said, I'm stunned. So let's dive into this. I think it's important for you to know how the underlying machinations, whatever it is, of stock market works. And when you do, you'll be a better investor for it. I'll give you my recommendation when we're done here. It's easy. All right, so we're going to go back to this. And I did a video somewhat on this the other day, but I didn't go deep as I'm going to do here. Hendrik Bessembinder at ASU, May 2018, to Stocks Outperform Treasury Bills. When stated in terms of lifetime dollar wealth creation, the best 4% of the listed stocks explain the entire gain of the U.S. stock market since 1926, as all the other stocks collectively just match that of T-bills. Crazy. I rely on the Center for Research and Security Prices, CRSP, monthly stock return database, which contains all common stocks listed on the New York Stock Exchange, American Stock Exchange, and NASDAQ. Of all the monthly common stock returns contained in this database, from 1926 to 2016, only 47.8% have a larger return than the 1 month Treasury. In fact, less than half are positive. So only 47% have a monthly return greater than the 1 month Treasury. In fact, less than half have positive returns. Just 42.6% of common stocks, slightly less than 3 out of 7, have a buy and hold return, inclusive of reinvesting dividends, by the way, that exceeds the return on the 1 month Treasury. More than half of the common stocks deliver negative lifetime returns. The single most frequent outcome observed for individual common stocks over the full lifetime is a loss of 100%. The single most frequent outcome. That doesn't mean it's the majority. It just means the single most frequent outcome of returns is a loss of 100%. And that kind of makes sense because stocks have an unlimited upside but a fixed downside. So we know it's going to be biased to the downside in terms of going to zero. You know what I'm saying? Because you could have a stock that goes up 90%, up 92%, 93%, but they could go high, but stocks can only go one direction, and when they hit that one direction, they're done. All right, well, but dummy, I shouldn't say dummy. I just tried to let him outside a second ago. He said, no, I don't want to go out. So let me do it again. So we have a bottom, a floor that you can't go beyond that floor. So we know that inherently makes sense that that floor would be what the greatest number would be, but still, it's crazy to me. The single most frequent outcome is loss of 100%. Individual stocks tend to have rather short lives. The median time a stock is listed on the database is 7.5 years. That just goes to show you how many stocks actually go bankrupt. Individual stocks have a short lifespan, essentially. The median of how long they're listed is 7.5 years. I can tell you. And by the way, just remember median, 50% have longer lifespan than 7.5 years, 50% have a less lifespan. Crazy. The fact that the overall stock market generates long-term returns large enough to be referred to as a puzzle, while the majority of individual stocks fail to even match that of T-bills, can be attributed to the fact that the distribution of individual stocks' returns is positively skewed. Simply put, large positive stock returns to a few stocks offset the modest or negative returns to more typical stocks. So basically, a few stocks carry the entirety of the market. And if you don't have those few stocks, you are S to the O to the L. Let's keep going. I calculate the approximately 25,000 companies that issue stocks appearing in the database since 1926 are collectively responsible for lifetime shareholder wealth of nearly $35 trillion. In the stock market, the collective shareholder wealth accumulation was $35 trillion. However, just 5 firms, ExxonMobil, Apple, Microsoft, GE, and IBM, accounted for 10%. The 90 top companies, slightly more than 1/3 of 1% of the companies that have listed common stock, accounted for half. Good. So my 90 of the 25,000. The top 4% accounted for all of it. That is, the remaining 96% of companies whose common stock has appeared in the database generate lifetime dollars that match gains on just buying treasury bills. Not only does diversification reduce the variance of portfolio returns, but also non-diversified portfolios are subject to the risk that they will fail to include the relatively few stocks that generate large cumulative returns. Indeed, as noted by some other guys, positive skewness in returns help to explain why active strategies, which tend to be poorly diversified, underperform relative to market-wide benchmarks more than half the time. These results imply that it may be useful to reassess standard methods of evaluating investment manager performance. Do you hear that? If you miss out on the couple high flyers and you're a concentrated portfolio, you can either make crazy bank a concentrated portfolio or you could get killed if you're concentrated. But you had 25,300 stocks to choose from. 90 did all your returns, basically, did all the weightlifting. There was another 1,000 or so that helped, but if you didn't get those 90, and so we've been talking about why the market always beats the active managers. We always say, oh, because the active managers' fees, high trading costs, whatnot. But not this guy. This guy's saying, no, it's not even that. I mean, it's something to do with it. But he's even worse than that. It's because they are so diversified, so concentrated, that they're missing out on just a couple of high flyers. And if you miss out on those couple of high flyers, your goose is cooked. I've never heard it put like that before. I've always known that active managers underperform. And the reason I've always attributed to is fees, high trading costs, whatnot. I've always known that a closet index funds underperform because of high fees and they're just basically mimicking the S&P 500. I've always known that, but I've never thought about it like the reason active managers underperform because of concentrated portfolios are missing out on a couple high flyers. There's 90 high flyers of 25,300 different stocks to choose from. 90. And if you miss those 90, you got underperformers without question. And then you factor in fees and high trading costs as well. We always talk about the Sharpe ratios and all this stuff. And I'm just like, at the end of the day, this guy's saying, no, man, I mean, I might something to do it, but it has to do with if you didn't have a diversified enough portfolio. I never thought about it like that. It's crazy. Again, I'm not some freaking rookie at this, dudes. Crazy. Let's keep going. I find that the percentage of stocks that generate lifetime returns less than those on treasury bills is larger for stocks that entered the database in recent decades. Interesting. So the more stocks that entered recently have a harder time performing. Isn't that crazy? This finding consistent with evidence reported by French Fama, who show a surge in new listings after about 1980 that included increased numbers of risky stocks with high assets but low profitability, and thus low survival rates. The recent evidence also supports the implications of another guy that the internet economy will be associated with a winner-take-all outcomes, characterized by highly skewed returns, showing increased industry concentration accompanied by abnormally high returns to successful firms in recent years, 100%. This is crazy. The percentage of stocks that generate lifetime returns less than those on treasury bills is higher for more recently listed companies. And why? Because the more recently listed companies have high asset growth, how much money is being thrown into them, but low profitability. I show in subsequent sections of this paper that the majority of individual stocks underperform 1-month T-bills over their full lifetimes, and that the bulk of the dollar wealth created in the U.S. stock markets can be attributed to a relatively few successful stocks. We talked about that. However, these results are not necessarily inconsistent with models implying that risk-averse stock investors require an expected return premium. Asset pricing models typically focus on average returns, while the evidence here highlights the median stock return is negative. So the average return of the stock market dwarfs the other T-bills. But the average is just skewed towards the outliers. Me and Bill Gates' wealth together, we have an average wealth of $8 billion trillion million. But our median wealth is like $1 because I got a median net worth of $1. And I just got that lost because I had to get dog food for knuckleheads here. So you see how the median is what matters. The average is irrelevant. Yeah, the reason the average is so good is because you had a couple high flyers. But the median, which is what you need to focus on, isn't good relative to T-bills. Crazy. Asset pricing models, what we use for statistical probabilities, all these things, the capital asset pricing model, all these stuff, typically focus on mean returns, average, while the evidence is the median stock return is negative. The median stock return is negative. It's crazy. Keep going down here. So I missed something gobbledygook on this. The low median return is offset by the small possibility of high extreme positive returns. The low median return is the lottery ticket. It's the lottery ticket. Asset pricing theories typically focus on mean returns while the evidence emphasizes median. We just talked about that. Let's keep going here. The data confirm that the mean excess return is positive, as the average monthly return is 1.1% compared to average monthly 1 month treasury is 0.37. All right. So we're talking about a quadrupling. The mean average monthly return is quadruple. Mean is the average, that of the 1 month treasury bill. Most notable, only a minority, again, mean. We're not talking median, we're talking mean. That's the average. Me and Bill Gates, our mean wealth is huge. Our median wealth is not huge. Oh, I bring down the mean, I should say. Third, and most notable, only a minority, 47% of the stock database exceed the 1 month treasury bill. In fact, less than half of monthly stock return, less than half monthly stock returns are even positive, which means half are negative. Isn't that crazy? Keep going. See my other highlights here. While 71% of individual stocks have positive arithmetic average return over their full life, only a minority, 49.5%, have a positive lifetime buy and hold return. So 71% of individual stocks have a positive arithmetic average return. Only basically 50%, less than 50% have a positive lifetime buy and hold return. And the median lifetime buy and hold return is negative 2.29. The median lifetime buy and hold return is negative 2.29. And we already talked about dividends being reinvested too, by the way. This result highlights that arithmetic return overstate actual performance for buy and hold. So when you see somebody talk, you got to know if it's arithmetic, geometric, and whatnot. And that's not going to get into that here. It a little bit confused me. I got to brush up on my ideas of that. But if they're just using the arithmetic return, you're like, because he just says right here, the median right there, lifetime buy and hold is negative 2.29, where the arithmetic return post positive arithmetic. A total of 3,071 stocks in the database, or 12% of the total, suffered essentially complete losses as measured by lifetime returns. 12% lost all your money. Most common stocks, slightly more than 4 out of every 7, do not outperform treasury bills over their lives. The fact that the broad stock market does outperform treasuries over longer time periods is attributable to the positive skewness of the stock market distribution, i.e., a relatively few stocks that generate large returns, not to the performance of the typical stocks. And then the question is, what stocks are going to outperform? I don't know. In fact, we can look at this right here. I think I went to, let me bring this up right here. I went to newspapers.com. I just typed in, let's type in Microsoft. Microsoft. And you're going to see right there, no one's talking about Microsoft about 1992. You know what I'm saying? Would you have bought Microsoft in 1992? Well, I doubt it. So we go here. No one's talking about Microsoft in 1992. Let's just see what some of the headlines were from Microsoft. Right here, what does this guy say? The question is, can IBM really lock marketing horns with Microsoft? Because that's what it is, a marketing battle, not a technology battle. IBM has been great at freezing the market in the past with fear, uncertainty, and doubt. The question is whether they can use marketing to activate a market. Microsoft with new products, Paradox in Windows and Quattro Pro for Windows. Computer firms put bite on each other. I mean, it's just, okay, that's fine. But were you actually buying Microsoft in 1994? Let's see. Here's that's 1992. Microsoft Money right here. So here's an advertisement. Microsoft Money for, it's just a software program. All right. Anyway, pretty interesting. Let's keep going back to the thing I want to talk about. On balance, the results on the table show that the potentially surprising finding that the majority of individual stocks that underperform the treasury bills over their full lifetime is primarily attributable to the stocks that were removed from the listing of the stock exchanges. Huh. Isn't that crazy? While this finding is intuitive and potentially reassuring, it is of limited applicability unless one can predict in advance the category which a given stock will eventually be found, i.e. to be unlisted, delisted. Despite the fact that small firms deliver higher median monthly returns as compared to large, the data reported in this other table shows a distinct pattern which small caps display more return skewness and a higher frequency of underperformance relative to benchmarks. Again, the same thing here. Despite the fact that small firms return higher mean average monthly returns, the small caps have a higher frequency of underperformance. So if you're going to be choosing small caps, you doggone better be right. While mean returns are not the main focus of this paper, it is of interest to observe that the small firm effect, by which small firms have greater mean returns than large firms, can be observed in monthly returns and a buy and hold annual returns, but not in buy and hold decades. In particular, the mean decade buy and hold return to large caps is 152%. Small is only 96. So I want to point this out. You can have, like he says, small firm effect on an average year, month or a year, but not on the decade. So your small company might do better over a month or it might do better over the year, but decade, tenure, an investment cycle, large firms did significantly better. Isn't that crazy? I can't stress this enough. While mean returns are not the main focus of this paper, is it of interest to observe that the small firm effect, by which small firms have a greater mean return than large, can be observed in monthly and in buy and hold annual returns, but not in buy and hold decade returns. In particular, the average decade buy and hold return to a large stocks is 152%, with 96% for small. The observation that most stocks underperform T-bills in the full database is attributable to stocks that entered the database since 1966. The more recent entrants, constituents, have higher volatility. There's more failures in the more recent ones. Isn't that crazy? The old ones, they held their own. It's the newer ones. For stocks that entered the database in the earlier decades, a majority, ranging from 61.5% of stocks entering from 1957 and 1966 to 87% entering between 1947, had lifetime buy and hold earnings that were greater than 1 month treasuries. In contrast, for stocks entering the database since 1966, a minority outperformed treasury bills, ranging from less than a third in 1977 to less than a half in 1986. In fact, the median lifetime return is negative for stocks entering the database in every decade since 1977. The older firms survived, the younger firms did not, and thus the younger firms have more fallen to zero. It's crazy. And if it falls to zero, that means right there, the median return is negative. The relatively high rates of underperformance for stocks that entered since the 1960s is attributable to changes in the types of firms brought to the public. Again, it shows Family French an increase in new listings characterized by negative earnings and strong asset growth. They weren't making any money, and yet they still brought to the public. While Fink showed that the firms brought to the market have tended to be younger. The finding that most stocks underperform the T-bill is concentrated in stocks as smaller than median market capitalizations and stocks that entered in the database later. So the smaller and the newer the stocks, that is where the concentrated of the negative performance is. It's crazy. So your larger stocks, not all of them, but your larger stocks have a better, higher probability of having a greater return than the T-bills and being surviving as well. The newer stocks and smaller stocks are a lot more risky because, again, we see why. They have negative earnings and strong asset growth. So people are throwing money at the growth potential. The database includes returns pertaining to nearly 90 calendar years, spanning from 1926 to 2016. However, for most stocks, the lifetime return pertains to a period much shorter than the full 90 years. In fact, just 36 stocks were present for the whole 90 years. The median life of a common stock from the beginning of the sample or first appearance to the end or delisting is just 90 months, 7.5 years. The 90th percentile lifespan, is just 28 years. The median life of a common stock in the database is just 90 months or 7.5 years because they get delisted and go bankrupt. Crazy, man. I think he talks about GM in here. But he did, and I'm not probably going to hit on it, but it was interesting. The fact that the overall stock market has outperformed treasuries is attributed to large returns earned by relatively few stocks. Yeah, I think we talked about that. The buy and hold returns considered in most studies of stock market performance, and in this paper, to this point, measure the experience of a hypothetical investor who reinvests dividends. It's crazy. And then he goes into something, if you don't reinvest dividends, this is where he gets his wealth creation. Because he gives an example right here. Where's the GE example? I thought it was pretty interesting. Yeah, consider as case in point GM. Not GE, GM. GM was delisted in June of 2009, following a bankruptcy filing. The delisting share price for its main class of stocks was 61 cents a share, compared to the $93 it traded at a decade earlier. Had the delisting share been zero, GM's lifetime buy and hold return would have been negative 100% because it went bankrupt. However, GM paid more than $64 billion in dividends to its shareholders in the decades prior to its bankruptcy, and it repurchased shares on multiple occasions. These funds were collectively available to investors for other purpose, even after GM's bankruptcy filing. Isn't that crazy? In fact, as I showed, GM stock was one of the most successful stocks in terms of lifetime wealth creation for shareholders in the aggregate, despite its ignoble ending. That's what I was thinking about that. So if you got a company that paid dividends, let's just say if you're reinvesting your dividends, all went to spot. In fact, you got to pay tax on that, which is horrible. But what if you own GE, you bought 100 shares of GE at $93? So let's just use that for example. And then went bankrupt. In the interim, made $150 for every share, just using this for example, of dividends. So you paid 93, you got 150 back, and then you went bankrupt. You still made money. If you reinvested dividends, you didn't, but you still made money. You did, and that's interesting to me because how's that reflected in the overall stock chart? Oh, you lost all your money? Well, you didn't lose all your money if you're getting a dividend. So again, the value of dividends. I can't stress this enough. But the drawback is if you reinvested those dividends, even if you didn't reinvest them, if you got the dividends, you had to pay tax on it. And if you reinvest those dividends to buy more shares, and zhoops, it gets delisted, you still have to pay tax on those dividends, even though you had nothing to show for it. I think that's pretty much all I got here. Let's see here. Let's keep going. All right. The largest amount of wealth creation attributable to any firm is $1 trillion by ExxonMobil. ExxonMobil. If memory serves, that's a Standard Oil when they got broken up. So as much as I can't stand John Rockefeller, and you shouldn't either, the guy made $1 trillion for shareholders. That's just a fact, dude. The second largest was Apple, which created 740. This is up till 2016, so it's going to be even greater now in 2024. Despite it was only around for 433 months compared to 1,086 months for ExxonMobil. Microsoft, hold on a second. So we got Exxon, Apple, Microsoft, another 630 billion, GE, 608 billion, IBM, 500, Ultra, Johnson & Johnson, GM, Chevron, and Walmart. The top 10. Look at that. I think I'm missing Johnson & Johnson. I mean, that's crazy. The implication is that slightly more than 4% of all the firms contained in the 25,300 size database collectively accounted for all the net worth creation in the U.S. since 1926. The 95.69% of firms outside the top group collectively generate dollar gains that match those that would accrue if you invested in 1 month T-bills. I think that's pretty much it here. I guess one more thing here. And if you're still here, I appreciate you still being here, man. Kudos to you. The results presented here reaffirm the importance of portfolio diversification, particularly for those investors who view performance in terms of mean and variance, the average and the variance around the average of portfolio returns. In addition to the points made in a typical textbook analysis, the results here focus attention on the possibility that poorly diversified portfolios will underperform because they omit the relatively few stocks that generate large portfolio returns. Actively managed portfolios tend to be concentrated. For example, these guys show that actively managed equity funds hold a median of only 65 stocks. The results, therefore, help to explain why active portfolio strategies most often underperform benchmarks, such as the S&P 500, that are constructed as average returns across securities available for investment. Underperformance rates that exceed 50% are often attributed to transaction costs, fees, and behavioral biases that sort of amount to a sort of a negative skill. The results here show that underperformance can be anticipated more often than not for active managers with poorly diversified portfolios, even the absence of cost, fees, or systematic behavioral biases. These results may require the reassessment of standard methods of evaluating investment manager performance, such as the Sharpe ratio and the Jensen alpha. And 100%. And I'll just go back to random walk down Wall Street. In my opinion, further confirm no one knows what the market's going to do. And monkeys throwing darts at a stock chart just as well as active people, just because we don't know. We don't know what the next Apple's going to be. We don't know what the next Microsoft's going to be. But it's out there right now. We just don't know what it is. And the vast majority won't be. The vast majority will be, you could have done better in T-bills. Now, I love your thoughts on this. This is such a great paper. I just could not be happier of reading this. It just really, you can see all the charts and stuff down here. Anyway, let me hear your content. Let me hear your thoughts, questions, thoughts. I'd love to hear it. All right, we'll see you guys later. God bless. Yep. Special appearance. See you.